Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Dennis Dick, and we are lucky enough to have Adam Sarhan back on today. He's the founder and CEO of Sarhan Capital. Did you enjoy your 3-day weekend, Adam?
It was great.
All right, we're glad to have you on.
Adam, were you watching though on Friday? Were you watching the jobs number, and what did you think of the S&P futures reaction, obviously, to the jobs number and ramifications potentially for today?
Yeah, absolutely. I mean, we're watching. What caught my attention, interestingly enough, wasn't so much Friday morning's number. It was the way the market was trading the day before. So Thursday's close. In the final hour, you had a spike up in equity prices. And it led me to believe that the market was expecting a stronger than expected jobs report. Now, of course, the futures market, the jobs report missed badly, and then the futures plunged Friday morning in an abbreviated holiday session. Overnight, since then, Sunday night and more or less this morning, they're kind of up a little bit, but nothing really too exciting. Really, the important thing for investors to keep in mind from Friday's jobs number, so outside of all that daily noise, bigger picture, what does it mean for investors, is that the economy remains very weak from the fundamental standpoint. And we've seen this pattern develop year after year, where since the Great Recession, since the '09 low, where you see the first half of the year tends to be softer than expected, or just basically weak economic data comes in month after month, and then in the first quarter, second quarter of the year, it's soft. And then, whatever reason, the second half of the year tends to pick up, and it ends with this positive note. So if that trend resumes again this year in 2015, then I'd have to say, okay, we can give the market the benefit of the doubt, and then we can move on and go from here. Now, the major variable that has been in place since the '09 lows, and that's led to that pattern occurring year after year, has been easy money from the Fed with direct injections of liquidity into the system via QE. So almost every single year since the '09 low, we've had some sort of direct QE in place. And if not, the market would fall. And then QE2 would come, and then QE3 would come. The same thing happened time and time again. So now that QE3 ended back in October, what we argued was, actually we spoke about on your show, was that the QE, or the Fed put, evolved. What does that mean, the QE trade evolved? It's now become, instead of the Fed QE trade, it's become a central bank put. So it's not just the Fed put, central banks around the world and their versions of QE and or very, very, very active easy money policies. And then that led stock prices to soar, even though QE3 ended here in the States back in October of 14. So now that we're in April of 15, we're seeing, again, the first half of the year, the first quarter so far, we can't say first half, but the first quarter of 2015, not just the jobs report, but economic data point after economic data point, it continues to woefully underperform. So the next logical question, it raises the question, is will the Fed, forget about raising rates, will they enact some form of QE4 if needed? And my vote is absolutely yes.
Yeah, and Peter Schiff was actually on the show here just a couple months ago saying the exact same thing that you're saying here, Adam. He doesn't believe that they're going to raise rates, and he actually does believe that they're going to have QE4 because he doesn't believe that this economy can survive without it.
Well, that's the whole point. I mean, if you look at this, again, we spoke about this on your show also months ago.
Yeah.
Here's the deal. I mean, basically, here's the bottom line. The economy, with massive Fed stimulus, easy money, rates are at zero, and every single major central bank in the world all in adopting some form of easy money, if not direct QE, the global economy remains, insanely weak at best, tepid at best. Now, the U.S. economy, with rates at zero and just finishing 3 massive QE programs, the largest QEs ever in history, we're flirting with almost negative Q1 GDP. I mean, we don't know what's going to happen what happened in Q1, rather, but more likely than not, the data Q1 GDP is going to miss estimates, and possibly, some people are saying, are going to go negative. Well, that's a conundrum for the Fed. What does the Fed do? They've done everything they possibly can do, and the economy is just not growing. The recovery remains one of the weakest recoveries in history, and that's their problem. That's what keeps them up at night. And then earnings are projected to be negative this quarter, for the last quarter, for Q1. And therein lies the problem.
Okay, Adam. So the big question here is, if you think interest rates are staying low for the foreseeable future, and potentially QE4 on the table, how do we profit from this?
You continue. I mean, you have to understand that the stock market the U.S. stock market is in a bull market. And right now, even with all this craziness going on, last week we saw the Dow up almost 300 points on Monday, and then down 200 points on Tuesday, and blah, blah, blah. And a few weeks before that, the market was falling. The all-time high for the S&P 500 was hit exactly 1 month ago. So that needs to be really, front and center here. And then secondly, even with all this chaos going on, the markets are going lower the past few weeks, we're only on a percentage basis 3.9%. So you're less than 4% below your all-time high in the S&P 500. So back in the day, I mean non-QE days when markets were quote unquote more normal, a 10% move up for the year was considered healthy. In the middle of February, the 3 weeks of February, we saw the S&P 500 jump 7%. So now it's just pausing to digest that very strong move. So when you see the S&P 500, the major global, U.S. equity index, rally 7% in 3 weeks from February's low of 1980 all the way up to February's high, that was a 7% rally. So right now you're pausing, you're digesting that move. Stepping back, the market still looks good, if not great. You're in a very strong bull market. As long as support holds, you have to give the market the bullish benefit of the doubt. And every time the market pulls back since 2012, we haven't had a 10% correction since June of 2012. Every time this market pulls back, it's shallow in size and scope. By size, I mean a shallow percent decline, and scope, it doesn't last long in duration. The pullbacks are short in nature. And that's bullish.
And the buyers just keep coming back in, too. That's the whole trouble here, is that every time we pull back, everybody's learned over the last 5 years that if you just buy the pullback, you get rewarded. So, like I've been arguing on the show for a long time, everybody's just learned that over. And if you're a new investor, that's what you know. If you buy a 5% pullback, you're going to make money. And until that doesn't work, everybody else is kind of almost self-fulfilling that there's going to be a rally because everybody jumps in.
Well, eventually, it's a game of musical chairs. Eventually, the music stops. And the people that don't have the experience, knowledge, or know-how, I mean, anybody can go out there in today's 2015 world of information overload. You can go out there in a click of a mouse, get every single major bull market and bear market in history. So if you're not studying history, you've got to ask yourself, do you really have what it takes to be in this game for a long time? But going back to the other point here, from an investing standpoint, right now, you're in one of the strongest bull markets in history, even though the economy isn't acting as well as it is. I mean, even the economy is not as strong as it should be. Let's put it that way. Now, part of my business, I advise institutions. So we have large fund managers and RIAs and all this fun stuff. So part of the advising of the institutions is I help them with a lot of different stuff, but more along the lines is these guys come to me with their ideas as well, and then we go back and forth. So to your point, I actually met with an RIA. He manages about $300 million 2 weeks ago. And the guy blew my mind. He said, Adam, why would I pick stocks? Isn't that a sucker's game? He's a younger guy, so he's in his maybe late 20s, low 30s. He's a family business, so his dad built the business. He took it over. And he basically outsources to other managers, buys mutual funds, and he's more of a financial planner than anything else. And he said, why would anybody buy stocks? And that just said it all.
That's a great...
Once he said that to me, and this is a guy who manages hundreds of millions of dollars for other people, and I just said, okay, that's when you start seeing the music, the game, the tenure of psychology, the crowd behavior just changes, and it's alarming because it can't sustain itself. It never has in history. Every single bubble's always popped. Every bull market's always ended. It's a fact of nature. So if you operate with the fact of your belief that the market's never going to go down, you're just fooling yourself, and that's not reality.
All right,
that's the first point. The second point... Sorry, go ahead.
No, go ahead. Finish your second point. I'm sorry.
I was just going to say the second point, when you come to invest, whatever the market is, I mean, understand that markets can only do three things. They go up, they go down, or they go sideways. Irrespective of the fundamentals of the Fed or whatever, enter the negative headline du jour today or positive headline du jour. It doesn't matter. There's only three things markets can do, and there's multiple time frames. So you have to ask yourself, what are you aligned with how the market's moving? Right now, we're in a bull market. Outside, all these negative data points, fundamental data points aside, the stock market's still 4% below its record high. The Nasdaq's on track to take out the highest point since 2000. The Russell small caps are leading; they're at all-time highs. The Dow's at almost all-time, just a few percentage points below. So just stepping back, take a breath. As long as support holds, we have to give the market the bullish benefit of the doubt. But if support breaks, all bullish bets are off the table.
Adam, we all know that we could talk about the Fed and interest rates and crude and all these different things, but the bottom line is earnings. And we are coming into the Q1 earnings season. We're getting things kicked off with Alcoa, and what this thing is looking ugly here. Is this the stock you follow? And if so, what would you be looking for going into earnings here?
Yeah, I would say in general, I expect earnings for Q1 to be soft, to be very weak, if not just straight negative, just because of the fact of what companies have been telling us. Secondly, Alcoa was kicked out of the Dow a while ago, just recently, a few years ago. I can't remember if it was 13 or 14. But the stock hasn't really gone anywhere. If you look back you had a big run after they got kicked out, interestingly enough. Might have been earlier. I can't remember. I think it was 13. But anyway, you had a big run after they got kicked out of the Dow. But since July of last year, the stock hasn't gone anywhere. Almost built a large topping process. So historically, Alcoa was the first Dow stock to report earnings. Everybody followed them, paid attention. What's going to happen? And it set the stage, for more or less that earnings season. Right now, it's lost its luster because the global economy shifted. Alcoa primarily in more of a goods guy. Their services are made to build stuff, for lack of a better way of explaining it. The global economy today, I argue, is more information-based. So the biggest companies in the world today sell information. They don't sell goods and services. Goods and products and physical widgets, if you will. So that's why, for me, Alcoa, even steel stocks, and more or less the companies that produce stuff have lost their importance on gauging the health of the global economy and the U.S. economy specifically. A company like me, what do we sell? We sell information. So people that sell Benzinga, what do you sell? Same thing. What are people buying when they come to you? They want to basically be smarter. They want to increase their intelligence. And that's more or less what we do. And that's what the biggest companies in the world do. Nike, look at Nike, Apple, Google. They don't sell physical products. Nike sells shoes. They don't manufacture the shoes. They sell ideas. They design the shoes. Someone else manufactures it. So Nike, I argue, they sell information, they sell designs. Apple, same thing. They design these products. They create the products, but it's more of information-based. That's
Adam, we got a question coming out of the chat here. What's a better deal for the average American? Low energy cost or a rally for energy stocks?
Joel, I think we might have lost Adam temporarily. I'm having a little bit of a tech problem on my computer right now. If you want to take a look at some technical on
Okay.
Alcoa, let me see if I can look at